What's up, everybody? It's your boy, Brandon, back with another edition of the Macro Insights podcast. But first, before we get started, a little disclaimer. I am not a financial advisor, and the guest is not giving financial advice. So everything you hear on this podcast is strictly opinion and should not be taken as financial advice. We disclose if we have any holdings discussed in this podcast, and you should not be following us as financial advisors. You should discuss this with professionals before you get involved or invested. And as always, it's not financial advice. So please, please, please take this strictly as our opinions and for entertainment purposes only. Now let's get into the show. What is up, everybody? I'm back with another edition of the Macro Insights podcast. And I have a very special guest. We've connected over Twitter recently. So I'd like to welcome into the podcast is Blake Millard. Blake, how you doing today, man?
Doing well. What's going on, Brandon?
Good. Everything's going well on this end as well. I'm glad you're here now. You're feeling a little bit better. You were kind of under the weather last week, so we had to reschedule. But why don't we, kind of bring it back and tell the audience a little bit about yourself and your experience and, what got you here today?
Yeah, sure. So thanks for having me as a guest. Just backing up a little bit. I was born and raised in Chicago, spent my formative years there, went to the University of Michigan, so I'm a big football fan. It's nice to see them back in the college football playoff after a bruising that we took last year at the hands of Georgia. So interesting to see because we're actually on the opposite side of the bracket, which either if we win, we would play a rematch against Georgia, which would be exciting, or we could play Ohio State, which is a big, I know, regional matchup, but I think it's pretty much one of the oldest, most renowned rivalries in all of college football, no matter where you are. So I think a Michigan-Ohio State final would also be huge for TV ratings and fans alike. So that's exciting in a couple of weeks. But so after Michigan, I went to Chicago to start. I graduated right into the global financial crisis, which was rather interesting timing. So I graduated in 2007, and at that time, markets were really starting to, crumble as the housing market was in all sorts of bad shape. So interesting story with one of my first firms that I worked for at the Chicago Board of Trade. But eventually I made my way out to the D.C., Maryland, Virginia areas, like as we like to call it, the DMV. And I've been there ever since, which, was a surprise. I actually only thought I was going to move into the area for a couple of years and then move back to Chicago because I just love the Chicagoland area. But, with careers and relationships, I ended up meeting my future wife, just ended up staying in the area. So now I live in Annapolis, Maryland with my wife, and we have 4 little kids. So had been with UBS Private Wealth for close to 10 years. Worked on 2 separate private wealth teams, very high-performing teams in the company. I think UBS has like 6,000 or 7,000 advisors. The 2 teams I worked on were both inside the top 100. So great experience learning how to manage portfolios, talk to clients, do manager due diligence, understand client reporting. So that was just a wonderful transition to where I am now, which is Sandbox Financial Partners. We're based out of Bethesda. We're a registered investment advisor, and we have a number of different advisors up and down the East Coast. I was brought in last summer, so the summer of 2021. I would actually fall under the Great Resignation, if we all know what that is. And I was brought in as the Director of Investments to essentially be the central hub for all of our advisors for trading, reporting, manager decisions, client conversations, allowing some level of scalability to really centralize the whole investment management process and allow our advisors to focus more on what they do best, which is building relationships and finding new relationships, while I manage more of the money and sit behind closed doors. And um, that's me in a nutshell.
All right, Blake. Before we get into all the financial stuff, I got to ask you two questions because I was born in Chicago. So Cubs or Sox? Which
Cubs, no
okay,
question.
good call, good call. And then is Justin Fields the guy? Because I know you're a Michigan guy, and he went to Ohio State. But what do you think? Justin Fields the real deal or not?
Yeah, it's really hard to cheer for an Ohio State quarterback for the Bears, but I've kind of gone back and forth on this one. He definitely has just electric speed, visibility downfield. You can really see why he was such a highly recruited quarterback out of college or out of high school and then into college, where he had tremendous success there as well. I think I'm still of the old adage where pocket passers are where you build, durable year after year success in the NFL. I just look at some of these more focused, running-centric, more running-focused quarterbacks with the injuries that they accumulate throughout the years. So I'm a bit nervous as to his longevity if he continues to sort of run first, pass second, sort of that mentality. But there's no denying he's an electric quarterback. He's got game-breaking speed. He can definitely change the outcome of a game in just a couple plays, which is really how NFL games are always decided. Is really the game comes down to 4 or 5 key plays, and he's a game breaker. So it'll be interesting to see how things turn out. It's his star is very bright at the moment. If they can put together a solid line around him, and the team sort of coalesces, who knows? We could actually see a perennial franchise quarterback, which is something the Bears have really never had since I've been born.
Yeah, exactly. I mean, I always tell people, I've seen a lot of bad quarterback play on the Bears, and I don't think Justin Fields is one of them. So, yeah, I'm
I
hopeful
always
as well.
remember I remember just growing up as a kid, we would always be playing the Packers, and it was almost like a running joke where on one side of the screen you would have the Packers starting quarterbacks over like the last 20 years, and there were 2 names listed. And then on the other side of the screen, you'd have this long laundry list of all the Chicago Bears quarterbacks that had played throughout the years. And I mean, you would just keep scrolling and scrolling and scrolling. So it's plagued the Bears for decades, what seems at this point. So if we can finally land on a quarterback that can actually be there for a number of years and you can build around, it'd be wonderful. But as you know, that's something that we can't ever seem to get right. And my thing is you got to keep drafting a quarterback until you finally do get it right.
Yeah, exactly. So hopefully Fields is the guy and we don't have to worry about this too much because we do have a lot of other things going around, especially in the financial markets. So, but you brought it up, you kind of started your career in, the 2008 crisis crash. So that's a really interesting spot to start, especially in the financial world. So, what were some of the big lessons you learned there? And, just kind of being thrown into the fire, what was that entire experience like? Just kind of getting started and getting your feet wet, but having a bunch of turmoil in the market.
Sure. Um, you know, Oftentimes the best way to learn is just trial by fire, sticking your feet right where it's hottest, and you'll make a lot of mistakes. You'll ask probably a lot of silly questions, but um, sometimes when you sit more in the wings, you're a little bit more protected. You might not formulate like a strong opinion. You might not be involved in those day-to-day conversations that carry weight. So I found just it to be meaningful, lifelong experience to get thrown right into that type of environment. Now, at the time, I was just obviously low man on the totem pole. I was just out of college, you know, didn't have that experience to really add any sort of value at that moment. But it was really eye-opening just to see markets in turmoil, bear markets, major corrections, recessions. Those are where you really sort of truly understand how markets work, how investor sentiment plays into things, human emotion. You can almost throw out the fundamentals at that point when you just have cascading liquids. We saw blue blood names, Lehman go down, Bear Stearns go down. You saw AIG get, handheld into conservatorship. Same with Freddie and Fannie Mac. So it's just, one domino after another, one scary headline after another. And I think just the whole experience that I took from that would be, again, just learning trial by fire. It's, just getting right to it, manning the phones, manning questions, doing research on why something is doing what it's doing. You just learn right there real quick. It's like drinking from a fire hydrant. You don't seem to always know what's going on or able to connect the dots at that point, but just valuable experience down the road.
Yeah, and I can imagine, but it's interesting because you said, you could kind of, I guess, throw out the fundamentals. And I kind of have a theory about that in this current cycle, but it seemed like, you brought up that throw away the fundamentals, and then it seems like, value investing principles for the past, decade or so really haven't been doing well. And it's a lot of these, growth companies with a lot of crazy PE ratios and, all the kind of like value investing metrics and whatnot were just absolutely insane. And you could just throw a dart at the wall, hit some random ticker, and that stock was going up. So, what was, I guess, investing in that kind of environment as well, because it seems like I guess maybe the generic fundamentals that, the Ben Graham kind of stuff and the value investing principles haven't really been, I guess at the forefront of investing, at least, it seems, I guess since your career has kind of started. Would you kind of agree with that opinion? And, what kind of, I guess, metrics did you see as, that kind of helped you gain some more success, I guess, through this like decade of growth?
Yeah, so it's been interesting, the sort of invisible hand of the market for the last 10 odd years. And then, of course, again here post-pandemic, which would be, the Federal Reserve and the FOMC, which sets policy, through their two main tools, which would be setting interest rate policy and then using their balance sheet to either, expand or contract based on liquidity in the system. So, it's interesting from really the market bottom in March of 2009 all the way through really pretty much when COVID hit. We just saw unprecedented level of monetary and fiscal support for the market. And what you ended up seeing was one of, if not the strongest bull markets in all of history. It's just, the stats that you can pull from whatever you're looking at and what time horizon, but the CAGR on the S&P was just remarkable. And I think when your backdrop is essentially a falling interest rate environment, and at that time coming out of the global financial crisis, where there was just still so much fear and uncertainty over the structural balance of the system, getting the housing market back in check after fraud and craziness that we were seeing. That perfect cocktail was set where it's let's put as much liquidity into the system as we can. Let's keep lowering rates. And what we saw was the market really take off, and some of that was also fueled, of course, by tech, where it really was in the right place at the right time. We saw tremendous innovation out of companies left and right, and from that we've now seen these companies dominate their categories. They're global leaders. These are household names, things like Google, Amazon, Microsoft. But yeah, I think a lot of that was enabled by just sort of the policy was set. And this is why monetary and fiscal policy is such an important piece of the puzzle, and something to always keep an eye on is they really can support or restrict markets based on the policies that they're setting. And we saw that post GFC, and we saw that again here post pandemic. So there's a few different things we could get into, whether it's expansion of the money supply, the balance sheet. That when you look at, actually, it's interesting if you just focus right there on the balance sheet of the Fed. Over a course of about 100-year period leading into the global financial crisis, the balance sheet itself was very steady. I don't have the exact figures in front of me, but it really just kind of grew very slowly through time. And if you look at a long-term chart of the Fed's balance sheet, you can really see two massive spikes in its entire data series. And it's right at the GFC, and then it's right again at the pandemic. So they realized that to essentially save us from a massive global depression, really what both scenarios would have set us into, it was, unloading that balance sheet, allowing them to pump liquidity in the system, keep the actual plumbing going while, we reset all sorts of bad actors, bad companies, valuations that perhaps had gotten stretched. So just allowing the Fed to sort of be that last lender, the invisible hand of the market. And I'd encourage the listeners here to pull up a chart, from Fred or wherever you can get balance sheet data on the Fed, and just look at a long-term trend of their balance sheet, and you'll see just these crazy spikes around the GFC, and then again at the pandemic.
Yeah, exactly. And I think around 60 or maybe even 70% of the total money supply that's in circulation right now has been printed within the past couple years, just because of, like you said, just kind of the shift in the monetary policy. So, I mean, do you think that because of, the way things, I guess, played out in 2008, that kind of gave I guess the Fed a little bit more confidence to use that tool and use that lever, even though it hasn't really been, I guess, used as drastically as it has in the past, in this, I guess, COVID crash, so to speak. So do you think that that's part of the reason why maybe they did it such drastically and so quickly, is making that decision just strictly because of, I guess, the situation in 2008?
Well, yeah, I think when you put yourself in the hindsight, you always have the benefit of hindsight, and it's 2020, as we know. But in the moment, when you really start to think about where things were in late 2008, and then if, again, you start to think about where markets were in March of 2020, things seem to really be falling off the rails quickly. And markets are a finicky thing. They really thrive on confidence. I know that sounds pretty simple and silly, but when confidence is destroyed, really the whole system sort of fails. Lenders won't put money out into projects that they should be supporting, whether that's homes or local businesses. Commercial lenders freeze up. The whole liquidity dries up. You have counterparty risk. So when you remove confidence out of the system, it can have all sorts of unintended knock-on effects. And I think by, again, stepping in with the AAA credit rating that they have, the balance sheet that they have, being the fiat currency, the Federal Reserve really is arguably the most powerful market participant out there. So I think that using your word confidence, I think that's an important part of, what they instill in markets. So again, when you put yourself back in time without the benefit of hindsight, and you start to see, in 2008, these massive investment banks that had been around for over 100 years, or in this situation, a health crisis, which is what it was, we had never really dealt with before. And, you take a global economy that's chugging along, and at that time it was performing quite nicely. Things were healthy. And you're asking the global economy to slam on the brakes and people to stay home, shutting down all manufacturing. Uh, you're shaking confidence out of the system, and you're now opening sort of this wide cone where the range of outcomes are vast and quite frankly unknown entirely. So I think you have to set policy the best you can with the information that's available. And I think one thing that they had realized from 2008 into using their tools this time in the pandemic is act swiftly and act with bring all the tools, open the checkbook. Let's not play around here. We really aren't sure as to what this, at the time, we didn't really even know much about the virus, how transmissible it was, how many people would be infected, what kind of numbers on deaths we would see, how long it would stick around. So I think it was more just perhaps an overreaction to keep markets functioning properly, so that we weren't going to set ourselves into a tailspin and some sort of years-long depression.
Yeah, but I mean, it is kind of an interesting time right now too, and like you said, you can always play hindsight's 2020 and all that kind of stuff, and we don't really have that benefit of the doubt, obviously, in the moment, or the benefit in the moment. But now it seems like the Fed is kind of, maybe trying to catch up by, raising interest rates. We've had, massive amounts of inflation. It seems like every month people are really anticipating the CPI print, and whatever it comes out as, whether it beats expectations or misses expectations, the market reacts pretty significantly. And we're recording this today on the 13th, and the CPI print came out this morning, beating expectations by 0.2%, but it was still 7.1% year over year. So, I guess, how do you view how the market's reacting in these drastic swings, even though, inflation's still over 7% this past year?
Yeah, no, we couldn't be recording at a more interesting time. We have, as you noted, the CPI number that dropped this morning. Tomorrow we get another Fed rate hike. These are some pretty major macro and monetary policy decisions as we close out the year here. So no shortage of things to sort of sift through. But on the inflation, traders didn't really set the latest inflation print would come in hot this morning. We saw markets run up a little bit yesterday. But yeah, consumer price index cooled again in November. We had the headline fall for I believe this is the fifth straight month. So now we're at 7.1 year on year, which is actually down from the recent cyclical high in June, which was 9.1. So definitely we've seen quite a bit of improvement in that headline number. 7.1, to your point, isn't anything to ring the register about, but we were at 9, could have been trending towards 10 or 11. So just to see this reversal, we'll see if it sticks. The path ahead is likely bumpy and will be some numbers higher than expectations, some being a little bit lower. But I think this is really, really encouraging to see on the headline number, essentially 5 straight sequential months in which inflation is dropping, up 1.1% month over month. That's encouraging. So, I mean, I think like I said, these are steps in the right direction. We're far from the Fed's stated mandate of 2%. And what's interesting about the 2%, I was actually at a wealth management, it was called a festival, not a conference, the Future Proof Wealth Festival back in September in Huntington Beach. And one of the main speakers there was Jeffrey Gundlach. And his whole thing, he was the keynote speaker. He spoke for about 20, 30 minutes. He was trying to drive there was how the Fed is just oversteering in this type of environment. They had to cut rates all the way down to zero. They held them there for obviously too long, that we know now. And now they're raising rates faster than any time in history other than like the early 80s. Pretty much since March, we've gone from 0 to over 4 in pretty much the blink of an eye. And I think what Jeffrey Dunlop was saying is, once we raise these rates to really stomp inflation out, which is really the primary goal here, is we then are concerned about having rates that are too high, potentially putting the economy into a recession, in which case the Fed would then have to, shortly thereafter start cutting rates. So all of this happening in a 2 or 3 year period where you're changing interest rates. And if you talk to any sort of bond trader out there, a few conversations I seem to be having, the volatility that we've seen in rate markets is just unprecedented, is, the word that sort of keeps coming up. But again, Gundlach was basically saying that you have the Fed just oversteering this economy. They're doing the best that they can, but they're looking at inflation, through the rearview mirror. The tools that they use are blunt. They take, it takes a while to affect the system. Policy we know works on a lag. Gundlach was then joking, how do we just magically safely land this airplane down back to 2%? What happens if we stay at 3.5%? What if we, crush things so much that we actually end up in a deflationary environment? Just landing perfectly at 2 is just some sort of magical fantasy that won't likely take place. What will likely end up happening is we will, at least our expectation, is we're going to sort of stop in the 3 to 3.5% range, which actually wouldn't even be all that damaging. If you think about where inflation had been for the last 20 years, we are well under the 2% mandate that the Fed seeks. So if we have some years where we're above trend versus a bunch of years where we're below trend, again, you're looking long-term at these inflation targets. I think seeing some sort of price growth is okay. For all those years, 2010 to 2020, where inflation was essentially almost nothing, the Fed had commented publicly that they were trying to get a little bit more inflationary prices to rise, and they really couldn't. So unfortunately, it took a global pandemic to really create both the supply and demand side, spike in prices. But I think if we can get these numbers down into the 3.5 range, I think we'll be okay. And who knows where interest rates will be at that point? We might end up having to cut just to get all the way down there. So time will tell.
Yeah, and like you said, it seems like the Fed is kind of aggressively raising those rates right now. We've never seen it at a pace like this before. 75 basis point hikes, kind of continually, but Jerome Powell's kind of hinted, I guess, a little bit at taking the foot, not necessarily off the gas, but, easing up a little bit. And, kind of the sentiment around financial Twitter and everything like that just seems like they're just screaming for a pivot at this point. And, I don't really, I've heard of various definitions of pivot. Some just believe it's stop hiking rates. Some believes it's actually pulling back. So, I guess seeing that maybe we have peaked in June. We'll probably know maybe in another year or so, but it seems like at this point, it seems like it's kind of going back down, according to like the CPI numbers. So how do you see the Fed, I guess, kind of playing this all out? And do you kind of see this? I mean, I guess if the Fed keeps being very aggressive, maybe they just ease to 50-point basis hikes. It seems like, the US might be best suited, but it seems like, globally it might send, other, kind of markets and everything else into somewhat of a recession or even a depression as well. So, I guess it seems like Jerome Powell has all this power and he's kind of pulling these strings, but, it seems like everybody's kind of hanging on his words. So how do you see it playing out? And, yeah, what I guess is, what is your outlook for, maybe the 2023's 24?
Sure. Lots to tackle there. I mean, I think what the Fed at this point is probably most closely watching is the labor market. Um, there's various ways to look at inflation. There's different categories, different markets. They seem to have taken care of a lot of the sort of transitory goods type inflation that was so prevalent in 2021 and then early parts of 2022. The mortgage market, which is the largest borrowing market here in the United States and in the world, January 2021, I think the low watermark on like the national mortgage rate was somewhere in like 2.6, 2.7. Just a few weeks ago, the standard 30-year fixed was quoted over 7. So right there, just in the space of less than 2 years, you completely crushed all of the crazy inflation that we were seeing in the housing market. Those anecdotal stories you'd hear about your neighbor next door selling his house to someone, sight unseen, not even with any sort of, inspection. A lot of that stuff has been, moved out of the market. That's what will happen when you take rates from sub 3 to over 7 in the blink of an eye. So the housing market, and then again, when you look at new home sales, existing home sales, mortgage applications, cancellations, all of that data is showing in real time and has been for half a year now at least, that the housing market is slowing. So that was sort of one, I think, goal that they wouldn't publicly state, but they're seeing those results. So you could almost consider that a check mark. And I think the second frontier that they were really trying to contain was and is the labor market. The labor market, the month-over-month wage gains that we're seeing, they're not quite staying at the level of inflation, but as inflation comes down, those wage gains are sticky. Just think about your back office person at a pharmaceutical company that was maybe making $75,000 in 2020, and they were either looking for new opportunities or to retain talent. These corporations, offered a 5% bump, 7% bump. Once inflation comes down, the company then can't go to that same employee saying, oh, we solved inflation, that 7% bump that we got last year, we're going to claw that back. That's just not how, the labor market works. That's not how employers deal with their employees. So those job gains that we've seen are sticky, and that's hard to sort of stamp out when we have, as tight a labor market as we have, and it's hard to find workers. So I think the labor market is really the last major frontier that the Fed is really trying to quell in terms of overheating. But when you have an unemployment rate sub 4%, we're adding somewhere in the neighborhood of 300,000 or 400,000 jobs on average for the entire year. This is a strong labor market. This is why I continually to pound the table that we're just not in a recession despite having 2 negative quarters of growth, GDP growth in the first and second quarter. By textbook definition, that would sort of define your recession. We'll see what the NBER, the actual governing body who sort of made that decision, they'll make that probably in the months and years to come. But no, I think when you have this strong of a labor market, I think this is really where the Fed is really still keeping their attention and trying to sort of see some easing in that. So how long does that take? We don't know, but what we'll likely end up seeing is you'll start to see it in the weekly jobless claims, which will then spill over continuing jobless claims. You'll see that in the month-over-month wage gains. You'll start to see these fractures, and we've seen it in tech. Unfortunately, tech is just such a small sliver of the labor market. So, while it's crazy to think that something like Facebook might lay off 10, 20,000 jobs, and yes, those are real people getting laid off, but we're just not seeing it in the more worker-intensive industries, for example, like manufacturing, which is one area that we did see some softening in the data in the last month or two, but really to get that unemployment number up, which is a terrible thing to do, we have to start laying people off, but that is one way to sort of slow down an economy. So I think the Fed is going to be laser focused on that. I don't think any softening comes in the next month or two or even three. So we're likely seeing a economy that still is performing strongly into the first half of next year. We'll see where earnings come in. I would categorize the second and third quarters as, better than feared is what I would classify that. If you strip out energy, you have earnings essentially flat or slightly negative. So it's nice to see a renaissance here from the earnings of these energy companies, but that's still such a small piece. The energy sector is only 5% of the S&P, so that's not enough really to carry the torch forward. So we'll see where earnings come in early next year. I think if the earnings picture really weakens, then we're sort of in a interesting position where you could really see a deeper recession than I think what the market is pricing in at this point. Generally speaking, people like to see 15, 20% drop in earnings. We haven't even come close to that yet. So I think that would be like the next shoe to drop, where you would then see markets really down and undercut the October lows that we saw from the S&P. So do we get there? It just depends really, I think, on the corporate earnings cycle. I think corporate earnings really ultimately underpin the stock market itself. So I think my forecast really for 2023 would be a volatile first half. I don't think today's inflation data changes really that narrative. I think as long as the Fed remains hawkish, they're raising rates. They might do it at a slower pace, but higher for longer now is sort of the new message. I think that still puts sort of a ceiling on where stocks can go, because we just don't know where that terminal rate is. And this isn't even getting into the conversation of a pivot, as you had sort of said, how do we define a pivot? Many people can define it all sorts of different ways. So it sort of means whatever it means to that specific person. But what a pivot would at least mean in this context would be just to stop raising rates. We want to know where the terminal rate is. Is that going to be somewhere in the high fours? I think I saw the market pricing, earlier this morning that the terminal rate is going to be somewhere probably in the low 5 range. And, from where we are now, that's only a couple more rate hikes and softball rate hikes, 25, 50 versus, these supersized 75 that we've seen 4 straight months. So I would say, succinctly, volatile first half, keep an eye on where the corporate earnings cycle is. If we see a major degradation there, we could be in some real trouble in terms of where stocks and, the indices are. if we can get through sort of these better than feared or better than expected results, and we sort of just flatline, I think the Fed can slowly start to ease and moderate their policy, moderate their stance. We'll have a very clear understanding of where that terminal rate might be. If inflation doesn't, all of a sudden skyrocket into 6, 7, 8% area, I know that that's a lot of ifs, but those are possible. Those are decent probabilities that we could get a tumultuous first half turning into perhaps some upside, in the back half. We'll see. A couple ifs there.
Yeah, and I mean, it's tough to make a prediction, so I put you kind of on the spot there, so I get it. But there is a lot of, ifs, and we don't really know how the Fed's going to react, especially with a lot of unknowns here in the market. So I do think it's a really interesting time to kind of talk about all this stuff, especially with all these question marks going forward, and kind of that's just stuff that we've never really seen. So with that note, I mean, we kind of brought it up earlier about the value investing principles, how we were just kind of seeing absolutely insane, PE ratios and what have you. Do you kind of see that, I guess, reverting back to maybe, some of the pre 2008 times where it was, I guess, value investing, kind of those principles were holding true, and the market made a little bit more sense on that note? Or do you still, like, I mean, I know you kind of mentioned the volatility, you still think it'll be crazy, but I guess future outlook, do you think if the Fed decides to maybe not get back to the low rates of basically zero that they had for that decade in between 2008 and COVID, and they kind of keep it, I don't know, at some terminal rate, do you think that those principles will kind of make for a comeback? Because I mean, personally, that's somewhat of my theory, is that maybe that'll kind of start to make a reversion back. But I'd love to hear where you stand on it.
Yeah, so just sort of stepping back, you have a 25-year average on the S&P, the forward multiple for the PE, you have at 16.8. Right now we're at 17.6, so we're slightly above that average. I know talking as strategists would like to see that number get knocked a lot lower. I think we were about 15 on the low end, but to get one standard deviation below that 25-year average, you have to get down all the way down to like 13.5. So, like I said, sort of in my heavily caveated sort of outlook for 2023, a bunch of those ifs, one of those ifs being corporate earnings. I think if you do actually see major deterioration there, that's again, likely see that multiple get knocked down to maybe one standard deviation cheap, which is where we never got despite all of these risks that have faced the market in 2022. But no, I mean, I think it's nice to see valuations not so stretched. The 22 multiple that we had at the end of last year was clearly overstretched on the upside. We needed some sort of correction. When you raise rates from 0 to 4.5% in the space of 6 months, you will get a major correction in markets. You'll see multiples compress. So these are all good things. I mean, I think it's nice to see sort of a renaissance in these value type principles, as you mentioned. It's nice to see like a return to cash flows meaning something and mattering. Now you can get that, from bonds for the first time in a long time. We went from TINA over the last 10, 12 years where there was no alternative really to stocks to, now they're coming up with all sorts of different acronyms, but TARA is one of them. There are reasonable alternatives. You can actually make money on cash now. Your money market might be paying 3.5%. Your 2-year treasury is going to be paying in the low 4s. You can actually get paid on some yield. So for certain investors, that's quite attractive. For those that are in retirement or that are a little bit more risk averse, bonds can actually pay you something. This is wonderful. But again, I think some of this behavior that we saw late cycle was just it was excessive. It was euphoric. When you look at sort of behavioral finance, the charts of where you are emotionally in the cycle, we were way stretched to the upside. So I think this sort of major reset, while it's super painful to experience in the moment, if you have a little bit longer of a time horizon, your prospective returns now going forward are so much better. You've seen major resets in all sorts of different asset classes. As I said, it's painful to go through. You have the S&P down 15.5% at the time we're taping. You got the NASDAQ that's just been absolutely crushed. That's down 28. You have the bonds. Where are bonds at year to date? Bonds are down. You have the the Bloomberg Barclays aggregate down almost 14%. You're setting up for potentially the worst year in a 60-40 history. That's not hyperbole either. Just go and look at the data. So these are uncharacteristic returns. They're terrible returns. We talk with our clients every day about how unusual this is. Part of the reason why you have bonds in the portfolio is, you get the income, which is great, but you also get ballast. You get these risk-off environments and stocks that can be quite punishing and damaging for longer-term returns. So you sort of hope to hang your hat on fixed income. And this year, when bonds are down, as I just said, 13, 14%, it's been ugly for a multi-asset class portfolio. So there's really been nowhere to hide. Energy has been, and commodities have been sort of lone standouts. And that's sort of an interesting conversation we can get into too, the decoupling between oil prices, which are now negative on the year, and energy, which is still ripping, up 60, 70% on the year. But no, I think getting back to these long-term valuation trends where we're much more in line, I think is just healthy for the market going forward. So these resets, while they're super painful in the moment, I think they're great opportunities for longer-term investors. Just getting to those points can be painful.
Yeah, for sure. There's definitely been a lot of pain in the market this year, to say the least. But I do think that there is some interesting sectors out there that, you brought up energy, and that there might be some other ones. We've had people on previous podcasts talk about defense and some other, maybe some interesting sectors, industries, what have you, that they're kind of looking for maybe a bright spot, even though the overall, market has been down. So what are a couple sectors that you have your eye on, and why do you like those with the potential of, I guess, a recession and what have you?
Yeah. So energy obviously has been one tremendous source of not only absolute strength, but of course relative strength as well. So that's an area that we've really liked to sort of essentially hide where everything else is just selling down. But you see these defensive sort of counter-cyclical type names that have really shown their weight this year. And unfortunately, it's coming from some of the smaller segments of, if you're looking at like the S&P, where again, like the energy sector is only 5% weighting, and that's up 57% year to date. I'm looking at industrials, which is, I think, only about a 2% slug of the S&P. That's down about that's down on the year about 3.5%. Financials are pretty interesting now that we are in a higher rate environment, and that interest margin on some of these balance sheets for banks should improve. I think consumer staples, that's always sort of an area in this type of environment. So, I think you kind of go by certain playbooks that have worked in the past. These certain sectors that should hold up reasonably well if we get into some sort of recession. Certain areas aren't going to perform as strongly than others. just sort of how we manage client money. Again, we're not going crazy on sector bets and with super short-term time horizons. We try to keep a focus more on longer term. So we're not doing as much in terms of like nuanced sector type positioning, but we have taken on some energy exposure early this year, which has been wonderful. I mean, it was the strongest performer last year. It's going to be the strongest performer this year. Perhaps we're in the midst of a commodities or energy super cycle. We'll see. You know, definitely some headline risk for energy trades as it pertains to the Ukraine-Russia conflict that seemingly is not going away, and Putin will seemingly not just give up and concede any sort of defeat, irrespective of what's going on the ground. But no, longer-term supply dynamics, I think, really favor that. We're just, we have rampant demand for this basic commodity. It's put into everything in the economy. Think of something, some sort of polymer that will revert, ultimately come back to oil. It's in everything that we use in everyday life. So the demand piece will always be there. And as we know, we are horribly undersupplied. And at some point here in the coming months, as the president and his cabinet has drawn down significantly on these SPR reserves, there's going to be another major buyer in the market. Think about the Fed with buying treasuries and mortgages for all these number of years. You're now going to have our government come in and be a pretty significant buyer of oil. But they got what they needed. They, especially ahead of the midterms, not to get into politics here, but they did knock oil all the way down. I think, as I mentioned earlier, it's negative on the year, despite all of these crazy headline risks that we've seen. So the energy trade is definitely, probably, maybe even getting almost overcrowded at this point, but that's definitely one area for people to look at.
Yeah, for sure. And, I definitely echo that sentiment as well. And I think, I actually had Dr. Anas Al-Haji on a Twitter Spaces, and I put it out on the audio as well. And he kind of went into the ins and outs of that with the recent oil and OPEC and Russia, EU sanctions and everything like that. So I think that's definitely an interesting sector to kind of keep your eye on. But, you've been very generous with your time. So I really appreciate you coming on the pod. And why don't you tell everybody where they can find you and what you got going on?
Yeah, awesome. No, it's thank you for having me here. It's fun to talk markets, and when we didn't even get into a whole host of things. We didn't even get into Twitter, what's going on there. We got crypto. We got the new CEO of FTX testifying. We had Sam Bankman-Fried arrested last night. We haven't even got into all the Wall Street calls for 2023 are coming out, which that in itself is always sort of an interesting exercise, which ultimately sort of means nothing because the estimates are always way off. But no, I appreciate you having me on here. You can find Sandbox, that's our RIA, Sandbox Financial Partners. Just Google Sandbox Financial Partners. You can find us there. I'm on Twitter. My handle is at Blake Millard CFA. And we also write a daily newsletter on Substack called the Sandbox Daily. We write Monday through Friday with sort of a narrative on what is driving markets either that day or that week, that month, topical. We cover stocks, bonds, macro, micro, markets here in the United States, abroad, crypto, technical analysis. We sort of try to cover it all so that, when you read our Substack Monday through Friday, or even over the course of a couple of weeks, you feel like you have a really good handle as to what's driving markets. There's no shortage of content out there, so we appreciate anyone who'd be willing to check out the Sandbox Daily on Substack.
Yeah, for sure. And like you said, there's really no shortage of topics here right now, but I want to be generous with your time. So I think the audience is really going to enjoy this, and we'll probably have to have you back on then to maybe take a
Awesome.
deeper
I'd
dive
look forward to
after
that.
after all this kind of settles with this SBF FTX kind of scandal and stuff like that. But
And
everybody go check out his
we'll
new.
have to see where Michigan goes and in the national championship, and we always talk Cubs. So no shortage of things.
Yeah, yeah. Maybe we'll have you back on if Michigan wins the national championship. You'll be smoking a
Would love it.
celebratory cigar, popping some champagne, doing all that. So, Blake, thanks
Look
so
forward
much,
to it.
and I look forward to having you back on.
Awesome. Thanks, Brandon.